Hi, folks. It's Aidan CryptoBurb speaking. Welcome to today's Friday webinar. Well, Bitcoin has been going all around the places in a little bit of a sideways channel, sideways chopping around both sides of the edges, to the upside, to the downside, and tilting a little bit above the average resistance and a little bit below the support. And it's kind of like climbing back inside, and it's playing all around, giving lots of tricks and whipsos, right? However, we're going to discuss today for why actually $30,000 is a potential impossible and reasonable target to be had as we are approaching and getting nearer and closer to the halving. Ladies and gentlemen, let's get this rolling right in a second. Welcome, everybody. Please let me know how you guys are doing. This is Aidan CryptoBurb talking to you straight from this beautiful office. I hope you guys, have been doing really well lately, even though the market has been choppy. This definitely doesn't help with directional trading. This definitely doesn't promote or help aid the trend followers, just the way that I am, and that my trading strategy actually relies on. However, it's been promoting mean reversion, right? Mean reversion, which means that the trend fails to develop and it kind of like bounces back and forth between the boundaries, between the frames. And this is what Bitcoin has been going on recently, in circles, between $22,000-$25,000, as it may seem, right? So the question is, what is coming next? And before we answer that, there are of course a couple of reasons and factors to understand and price in. Also, depending on something that we know otherwise as intermarket technical analysis, who's one of the pioneers was John Murphy, right? Intermarket technical analysis collides and puts a little bit of a consensus between many different markets, right? Because ever since the market kind of like started, floating free, in the 20th century, the popularity of technical analysis has been emerging and has been increasingly more important overall to trading. And this definitely made a lot of markets connect and kind of like, clash with each other, right? And ever since those connections, were established, some of the traders noticed that certain markets at certain times of the year, at certain seasons, tend to trade together, while on the other side, on the other hand, they tend to trend in the opposite directions on another seasons, right? So the question is, how does it work? And the answer comes with understanding that technical analysis is not a vacuum kind of like a tool, right? The markets are not trading in vacuum. And because of that, it may happen that with all the dynamics, just like we have the war, still double-digit inflation, however, it's coming off lately. Many other factors that are really unpredictable. Some people have started, reporting seeing strange UFOs, all over the United States and across the globe. So you never know what's coming, right? And each and every single butterfly, flapping its wings can really cause this snowball effect and this kind of like butterfly effect, if you will. And for that reason, there is a lot of noise, a lot of uncertainty, and a lot of guessing in something that we cannot really ever be sure of that remains to be at future. Well, let's have a look from the intermarket technical analysis perspective standpoint, or what context actually Bitcoin is trading right now with, right? So here we are, trading and breaking to the downside below local support. Given by the industrial average, by Dow Jones Industrials, right? Top side of the chart is industrial average. Bottom side of the chart actually corresponds with Dow Jones Transportation, which broke below critical support. And we may see that this one average doesn't confirm another, right? Well, transportation average kind of like show a little bit of the resilience and strength, also driven by strong Tesla performance and consumer discretionary sector. The Dow Jones Industrials kind of like, just faded and evaporated and moved to the upside, right? So there was a lot of failures, local failures, right? There were a couple of ideas to and approaches to break above 34,000 points on the Dow Jones Industrials. And even though we are trading still above the 200-day trend average, which is positive, this definitely shows this short to medium term trend shift, right? As we broke to the downside, to the upside for the first time ever since the bear market started. We also know that the pre-election years, that happens to be 2023, have historically been extremely persistent in going up. as in the pre-election years are known for their persistence in going up, for the trending up in a very, very bullish environment most of the time, because over 84 years of data, ever since 1939 and 49, we are really talking about the, well, accuracy ratio, which is insane and incredible, right? 84 in the last 84 years, only one single case actually was wrong and was mistaken, right? And it was aligned with some black swan that was unpredictable. Other than this, each and every single pre-election year over the last 84 years, well, goes up, right? Otherwise, tell me which president candidate would want to step into an office with sinking ship, with sinking market, right? Every party would do everything they can in order to drive the markets up, so that at this perfect time of their elections, they just enter into plain, beautifully managed market and a very increasing trends. Right. That's what I want to see, because that is the very straightforward confirmation to many electors, to many people who would go for the elections and vote. Right. That these guys know what they're doing with the market. Uh, that's the illusion. However, people love to believe in those kinds of illusions, right? So one way or another, we are kind of like sinking lower a little bit below the support. However, still maintaining this overall frame of a sideways movement and above the positive 200-day trend average breakout, right? So the overall consensus is still more positive than bearish. We still have escaped, managed to escape, this bearish tendency of 2022, which is positive. This is clear, consistent, dominant shift in the overall the market performs in the overall direction. However, locally, we've been chopping around, right? Chopping around, which means with tons of whipsaws to the on the upside and on the downside, and that's what it does. That's what a sideways chop kind of like does, right? And one of the points that actually brings a lot of question is that the Dow Jones Transportation saw this nice upward thrust, this breakout to the upside, which was which was overall non-confirming, right? So the Dow theory basics basically tell you that the averages should confirm each other, right? Whenever there is, let's say, Dow Jones Transportation and Dow Jones Industrials, the economy or the actual, healthy state and condition of the market and on the economic cycle, um, that basically saying that everything is fine, that everything is in order, that everything is right on the track, happens only when these averages confirm each other, right? And then this disparity, directional disparity, and also the performance difference between the Dow Jones Industrial Transportation tells us that something is off, that we're not out of the woods, right? And naturally, we have just escaped this long-term bear market, right? Then before we start blowing, out insane, bull market rallies, we still have the headwinds to fight, right? The economy is still not in perfect condition. We're still looking at deeply inverted yield curve, which had always preceded, the recessions. So the questions populate and keep coming up. The S&P 500 is testing the 200-day trend, which is a little bit more declining if you compare that with the Dow Jones Industrials. This tells me that there's a little bit and slightly more bearish tendency for the S&P 500, because this average continues to kind of like slope down. It's very mild. It's very, minimalistic. And nothing to be compared with the slope and the angle of the average decrease. In 2022, it's definitely shifting the direction, and there's a lot of positive breakout, new high, doesn't high, the low, the market low, the high, the higher low, and the higher high, right? So this technically, based on that theory, kind of like starts classifying that as an uptrend. We are looking at this positive signal and of strength unseen since 2021. As a matter of fact, and well, this tells me that a lot of has shifted. However, the February, as the seasonality study suggests, per also amazing resources of Stock Traders Almanac, mm, they tell you that February is a weak link more often than not, right? Which means that in the overall, sweet spot and the bullishness of the first couple of months until May, typically of the pre-election years, February is the weak connector. February is the weakest month. For this reason, we should probably expect that, well, with February coming to an end, uh, then it will make a lot of sense, of course, to anticipate a little bit more bullish reactions in the following weeks. However, for now, we remain, with this fake overthrow at the top with a little bit of a failure, right? This inability to break above 4200s, well, tells me that it's locally bearish. Of course, it's plunging. It's really not doing well at this very present moment. It's pulling back and reverting back to the mean, which eventually was intended to do. Because even if the market is going up, even if the average is going up, the market will oscillate around the average, will come back and revert back, deviate and come back towards the mean, right? The mean reversion happens and occurs in the corrections. If we are to have a look into the sectors rotation, or actually sectors comparison for the performance of the S&P 500, then let us have a look at what's been going on over the last 37 trading days, if you will, right? And we can clearly tell that still that even though there's kind of like a little bit of a pickup on more of the energy side, and just tiny bit of an uptick on the healthcare. However, with a decline from utilities, consumer staples, all of those recessive, if you will, candidates, as in the energy sector, utilities, defensive healthcare, right? Our consumer staples are all kind of like underperforming and are all trading below the break-even level, below zero, right? So they are negative after 2 months into the 2023. We are looking and observing that defensive stocks are bleeding, while and whereas the positive and risk on sectors, the cyclical stocks such as consumer discretionary, this is pretty amazing that it's led by consumer discretionary, because this is exactly what a typical bullish setup looks like, right? For the bull market, it's driven by cyclical stocks, the ones that are very growth oriented, very risk oriented, right? So we were looking consumer discretionary, communication services, as well as technology. This trio, this trinity, is basically performing somewhere between 10 and 14% year to date performance. This is pretty okay, I would say. Please let me know if it makes sense, everybody. If you're watching that on YouTube, this is a kind reminder to make sure you hit the subscribe button, smash the notification bell on as well, so that you stay notified every time we put out new content. And there is tons of content for you to digest every single day with the Burp Nest ever since 2017. If you're watching this right now, congratulations. Give yourself a round of applause, because you are a bear market survivor. Right? This is what the market tells us. Of course, we cannot predict what's going to happen in the future. We cannot tell, that the Jurassic Park, and 1 year or another is going to come up and the dinosaurs start walking on planet Earth again. You never know that. Perhaps people, are going to come up with some crazy ideas, and the UFOs strike, back, and the Martians attack, and all those crazy, hard to imagine things just collide all with one another, and it can disrupt the most bullish setup ever known to human, right? And there's nothing we can do about that. We cannot predict the future. We can only react on probabilities. And if just stop for a second, and try to figure it out, because I know that there are lots of voices, that technical analysis doesn't work, and it only doesn't work. I hear those comments after people lose, right? So apparently, if it works, everything is fine. If they win money, everything is fine, and they don't blame technical analysis. However, because of something that is known otherwise as self-attribution bias, which is an error in the thinking and rational thinking, basically, we tend to attribute the success to ourselves, to our own genius, and blame everything that is bad, that is losing us money, on the outside factors, right? So one way or another, I just want to say that myself, as a CMT, as a charter market technician, the only charter market technician from Poland, I am a man on a mission to kind of like debunk myths, right, about technical analysis. And a very simple analogy, and this is a very simple analogy because it actually just corresponds with a lot of universal laws and rules, also rooted in statistics and the things that the science performs. If you cannot prove that, you cannot prove directly that technical analysis kind of like has some predictive power. Typically, you try to do it by proving or disproving the antithesis, right? As in the alternate hypothesis, which means that you kind of like assume that technical analysis has 0%, zero, like value, right? And if you can debunk this myth, if you can prove this hypothesis to be wrong, this anti-hypothesis, then it means that by negation, you can confirm that it actually has. And many predictive and many technical rules, many technical analysis, as we kind of like measure the returns, they are proven to generate positive returns. So if they're generating consistently positive returns over a long period of time, then is this really random? Right? The random would give you 0% because you would lose as much as you would win. Right? It's not producing negative returns either. So it means, well, some of the techniques do, of course, right? However, the point is to kind of like stop for a moment, freeze, hold on, and then turn on the rational thinking. So, of course, we don't know what's going to happen in the future. Same way you don't know what's going to be the weather tomorrow or this summer, right? So, any person who says that technical analysis doesn't work, that trends don't exist, that everything is random, that there are no trends, is a little bit like trying to bet on negative temperatures in the summer, right? Because of course we don't know the future, right? Of course there is only, let's say, like I said, 84 years. On the last 84 years, only once that pre-election years were bearish. So is it, you have to ask yourself as a trader the question for whether or not it is worth to trade counter such metric, right? If you know that over the last 84 years the temperature in summer was above 30 Celsius, then would you bet against negative temperatures, or sorry, would you bet against the positive temperatures, and would you bet on negative temperatures during the summer? Right? Those are the kind of like rational questions that you should ask yourself. And the fact that once at one time you lose and at the other time you win is not changing the fact that technical analysis is a beautiful art and price study that really works, And it is rooted in many behavioral biases that we as traders just have to overcome. And that's why we dig in deeper into the market. We find ourselves kind of like trying to, just fight our minds. Here is the potential double top formation for the XLE, which is if broken and if validated to the downside and breaking below the consistent and confluent support of a double top neckline, and at the same time aligned with the 200-day trend. If it actually manages to break down below 80, for XLE, for the energy sector, the chances are that it's going to continue because a little bit of a self-fulfilling effect and, well, some actual structural change in the inside of the market, is going to be apparent. And if that is the case, this could be potentially having bullish implications for the risk assets and for cryptocurrencies, right? Because expensive energy doesn't really serve anywhere or anyone well. Otherwise, consumer discretionary versus relative strength ratio versus the XLP, this is a little bit of a risk on, risk off environment. We can tell that there has been an attempt and successful breakout over 200-day trend. However, it's a little bit of a chop. We are looking that it's kind of like locally right now below. However, still below the valid kind of like a support right now. So it's definitely having time, time and place to kind of like decline even more a little bit. It's not that the directly tradable asset. However, why it matters is that it shows relative strength, and relative strength, which means that what kind of like tells you which leads which one, right? Which leads another. And XLY is locally kind of like being led by XLP. The XLP is slightly strengthening, and it doesn't necessarily mean you could see this as the XLP kind of like going flat or inclining just a little bit tiny. And the relative study says that it doesn't need to be the case that one increases and one decreases. It can be done one grows faster and the other grows slower, right? Or more slowly. So here we are looking at a situation where the relative strength ratio is a little bit, in favor of the risk off locally. However, an overall trend regime of the past, 2 months has been positive, right? So this is the context. We are looking at a local correction. And the more of these studies, show up, the more the bullish the signals are in the context for the markets. Deep yield curve inversion unseen since 1980s. Like I said, it's not necessarily the most constructive economic feedback, because the traders are anticipating, definitely anticipating, the recessive environment, right? Every single time the recession came in over the last years and decades, had been preceded by inverted yield curve. So again, are those the odds to trade counter? The relative strength ROG side, perfect Julius the Campanara's tool, the market is telling you that there is a positive market rotation towards risk on, right? It's clearly seen that it kind of like inflows to the leading quadrant, which is strong in momentum and relative strength. It's increasing, or very strong sharp tails, positive turns into the leading quadrant, while there's an outflow and kind of like move towards weakening and lagging quadrant for the utilities, for staples, for healthcare. So all the bear market setups are kind of like fading away, and all the bull market setups are starting to come through, right? Which is positive. Locally, I'd made a couple of points, for why Bitcoin's case, was bullish, right? Overall, despite local corrections, of course, it's not the most bullish case, that we're kind of like, not maintaining this perfect technical example that it breaks out and makes an ideal resistance breakout and a support to pull back to, of course, the word is not ideal, is far from ideal. And what matters, though, is that this breakout that we've seen to the upside is confirmed. And it's confirmed on the volatility basis. It's confirmed on the volume basis. You could see that this breakout came in with the volume spike, which is confirmatory. You can tell that it's traveled more than 60% from the bottom. So it's like this cannot be just an accident, right? An accident can be a move 1% up and then 1% down. However, if it chops 60%, if it chugs 60% in one direction, it's not necessarily an accident or a coincidence. It spent a good amount of time, almost 2 months, outside of the average or above the breakout level, right? So there's like so many confirmations to validate this trend breakout and the structural change in an overall trend regime. So this is an infant stage of a bull market. That's what it tells us. It's not a bear market anymore, and it's broken above in the bullish direction. This tells me there's an infant stage of the bull market. Infant, which means it's undeveloped, immature, and it's likely going to chop us around. The market is not caught up fully and strongly, to bullish momentum. There are still many traders to come and rediscover the market to bring the demand influx, right? And the more money in the market, the more momentum potentially can have. The bigger the speeding track gets, and the harder it is going to get to stop it once it actually starts moving. Hope it makes sense. So now let's answer the question real quick, because that was the very case. Why $30,000 could be a positive target and reasonable target for the halving, right? We know that the next halving, typically happens every 4 years, and kind of like similar on the pretty much similar time. However, this changes and it's dependent. The network is dynamic. For now, it's basically settled and scheduled a little bit somewhere towards the start of the March, right? So here it's marked for the 4th of March, and last time I checked it was 1st of March. Regardless, this brave new liquid coin index, tracking the Bitcoin prices ever since the very origins of June 2010, tells us that we are in the 5th bull market. Each and every single signal and setup that had been seen before, that preceded strong bull market emergence, is exactly seen right now. This is the very same setup. So of course, is this worth trading counter, right? The thing I noticed is that each and every single time at the moment of the halving, we are somewhere 60%, somewhere around like 60%, from the local or the previous cycle top, right? So here we are about 60, 70%, if you will, right? Then if we kind of like go further, from the 2013 peak, of 1250 down to actual, let's say, moment on the price chart that Bitcoin was at, 60, 64, 65%. The next halving, right, was around, hang on, let me just repeat it, was from 20K drawdown all the way to 60% down to the actual current price of Bitcoin, at that time. And again, there's no guarantee, right? There's no guarantee for the future, for what's going to happen. However, if you see the odds and set in a repetitive pattern, note that it is a small sample, so it may be just local, kind of like seasonal pattern, and not something extraordinary. It may well be proven wrong over the time, over the next decades. However, locally, with this small sample, what we know is that typically Bitcoin likes to be in favors these odds of 60, 70% drawdown, from the peak. which basically takes us, somewhere from like 60, 70%, takes us towards like 30, this overall area of, if I were to put it, hang on, um, all this previous support, right? So this previous support of the 21, kind of like 22 2021 moments, we're aligning with the support level, the neckline, whatever you name that, at 28, $30,000. So of course we know that typically into the halving, the bull market had already started, right? So into the halving, the bull market had already started. So think about that, right? Again, we have this exactly same repetitive pattern telling us that if the bullish odds are to be maintained, and this pattern is to be continued, then we are to see probably something, a little bit of a sharp recovery, just maybe, into, I would argue, this is just raw speculation, and maybe we're well off about that. Just don't trade based of it, of course. If I were to guess, I'd say we may just fly in somewhere towards like the 40, 30, $40,000, maybe even higher, maybe 49, 50, whatever. However, if I know that historically Bitcoin likes to be, around 60%, 60, 70% to the downside, around the halving even, then this places it, somewhere between 25 and $30,000, right? And $30,000 is this beautiful round number. People love round numbers. It's easy frame to remember, right? And this makes it so much easier for us to kind of like frame our brains and minds this way. And gents, so ladies and gentlemen, this is a very simple answer actually, right? For why we think, the bull market may enhance 2023 recovery all across the board. This is the strongest and the most bullish year within any presidential cycle. 84 years, only one loser. The January biometer with 83.3% accuracy ratio closed bullish, right? Which means that you have 83%, more than 83% of the chances so that if the January closes bullish, the market turns bullish for the remainder of the year. So we have all the bullish odds. The bullish breakouts are above the long-term trends. All those things, well, seem to me that we're looking at the bullish emergence. And if that is the bullish emergence, we're looking to the upside. And even though we should ignore a little bit of noise, some tertiary fluctuations that are irrelevant, this is a thing and setup to look at, right? 2023, 2024, as we're heading towards halving, we should have already, we will have probably already been for some bullish seasons until then, especially as the seasonal patterns appear and reemerge in the Q4 of the year. So probably a little bit of a stronger kind of like a push March, April, towards May. May sell and May go away. That's what the typical trading saying says. Slower Q3, stronger boost into the halving as we approach halving towards Q4, and a full bull market emergence. I would argue towards 2024 and beyond, right? We'll see how it goes. This is my pure speculations. I trade on the trends and on the trend breakouts, which is way different. And I mentioned that many times. And before I go, I want to just remind you that we are still reviewing the interest, because we may bring back, after 3 years of non-existing supply, right? We didn't produce that. We are coming back with our hoodies. So if there is enough of interest, of course, we may just get you one for free. If you stay tuned, you may catch a hot giveaway soon. That's it. God bless you all. See you around. Thanks for stopping by to watch this Friday's webinar with the Burpness. That's been Adrian CryptoBurp talking to you. Have a blessed Friday. Bye-bye.